Welcome, everyone. Hi, my name is Federico Invernizzi. I'm the Chief Operating Officer at MDOTM. And today I'm with Axel Maier, who is the Head of Global Business Development for the company, and Tommaso Migliore, the CEO and founder of the company. And we'll be discussing our new service, the Portfolio Sanity Check. So how we use our technology to validate and to observe and analyze portfolios of our clients and help them position for future scenarios. I'll leave Axel to introduce the company and the service, and then we'll dive in depth into all of this.
Thank you, and good afternoon, everybody. We thought it's important to put all of what we're going to show you a bit of context where that fits within our company and where it fits within the space of artificial intelligence. So MDOTM is a reasonably young fintech company. We've been founded 5 years ago and started offering investment strategies purely on the basis of artificial intelligence. What was very clear from the beginning was that since investing has become a tech challenge, that we need to make sure that our clients really do understand this new science, this new kind of way of managing money. And so it's critical for us that there's a clear understanding of how our AI works. And we also want to help clients take that step in that we give them control of the final execution of the strategy. The way we come up with new strategies is through a very close and thorough dialogue between a group of industry veterans who actually sees and hears what's happening within our client markets, what the regulator does, and what clients need to meet their investment objectives and, of course, adhere to their regulations. So within that, we currently offer 4 different strategies. So there's a multi-asset strategy, there's a single stock equity strategy. What we have here under alternatives is a hedge fund replication strategy and proprietary trading. And then again, if you put that into context, we basically have these 4 strategies, but we offer things within 3 kind of services. First of all is portfolio advisory. And this is where we run a portfolio for our clients according to the client's parameters and whether the client can have the final decision about the execution. The second one is asset allocation support. And here's where clients would get the asset allocation output of our model, which will only be on a regional or sector basis, so not going down to the single stock level, but this can give clients a very important input in the way they actually build their portfolio. And lastly, and this is what we're going to show you today, we offer portfolio diagnostics, or like a sanity check of our portfolio. Within that sanity check, we use our AI models to assess an existing portfolio. So a client would provide us with a portfolio and would ask us, can you run analytics on certain risk return characteristics? Can you do a scenario analysis? So how would the portfolio do in a context of Lehman going bankrupt, of the Russian debt crisis, or of the current crisis as well? We then can also show how adjustments can be made to that portfolio to increase the efficiency. And so for a client, it's basically a good way of having an independent view using a new concept of artificial intelligence to look at their portfolio and give them hopefully the sanity every client wants to have in running these portfolios. And so this is what we're going to do today in the next 25 minutes to use an existing portfolio to run these checks through you so you can see what you would actually get out of it if you would use that service.
Fantastic. Thank you, Axel. So before we move into the first of these 3 steps analytics, I'd just remind you of what is it that we are going to look at. So the first part is analytics and scenario analysis. It's something you've heard of for sure, but we do it in a peculiar way. Then we go into the more new part of it all, which is the portfolio positioning. So we'll show something interesting and new about how the portfolio is is going to behave as conditions vary, and both past conditions and simulated future conditions. So we'll see that with Tommaso. And then we'll go into portfolio adjustments, meaning you have a portfolio, you have constraints, and you have a view. So you expect the market to be in a certain way, and you want to position yourself in order to better catch that opportunity that you see there. For example, you believe in a rebound in the market in the coming months, and you want to position your portfolio, given the constraints, to better exploit that opportunity. So we'll go into that. And finally, the client experience, meaning how it works, what we would exchange in terms of data, in terms of input and output that will go around. I'll start from the first part, which is the analytics past scenario analysis. So what you see here, this is a sample report of a portfolio we analyzed. And of course, we start from something that is closer to risk management, but it's the starting point to analyze any portfolio. So first of all, we'll go into analyzing the risk metrics of a portfolio. So how it performed in the past compared to a benchmark. A big part of it all is the selection of the appropriate benchmark, which may or may not be the contractual benchmark, because a lot of these analyses make sense when you compare to the appropriate mix of instruments to compose your benchmark. So we'll work on that. And we, of course, according to different models, so to parametric and to historical VAR models using Monte Carlo simulations, we estimate the risk of those portfolios, and we compare that to the benchmark. And that's the starting point. Then we move on and we look at scenarios. So first of all, we look at past scenarios, because we know to understand the portfolio, you'd want to know how it would perform in 2008, how it would perform in 2018 in December, and then in the rebound in the couple of months following that moment. So to do that, what we're proud of is the technology we have and we can deploy to take a portfolio. For example, you have a portfolio that is composed of new funds and ETFs. ETFs are appearing on the market by the day, and funds as well, as you know. And how do you go back to 2008? So we exploit here part of the technology we use to do our model and allocations for the clients, and we deploy that to find the better proxies for that portfolio in the past, in order to show how that would have behaved in terms of course, the return, the losses, the efficiency in relation to the benchmark. And of course, if we look at the sample portfolio, the first couple of events, so the Lehman Brothers crash and the rebound, successive to that, a few months after that, the market rebound. What we can learn, and of course there needs to be some analysis besides the raw data, is, for example, that the portfolio we have compared to the benchmark is riskier. As you see, it loses more, it earns more in the aftermath. But it's asymmetric, and it's interesting, and we'll see with Tommaso's bit of analysis in a moment how that can be shown. So this portfolio, for example, loses as much as twice the market in the drawdown, but when it goes up 6 times roughly. So that's interesting, because it shows, of course, the basic finding would be it's riskier than the benchmark, yes, but how so? Is it linear? Is it non-linear, this relationship? And we'll see and apply to your portfolio this kind of analysis to see how and what to expect in different market scenarios. So this is what we do for the past. Then we do projections. So for example, and this is helpful in a lot of cases for risk management purposes and to better understand your next moves. So how safe can you stay? How should you prepare for especially in these volatile weeks, how can you prepare? So we look at forecasts in terms of market volatility, portfolio instruments volatility, and how would that look in a couple of weeks time, in a month time, if you have that scenario happening, if you have another March 2020 happening. So you'd see immediately how your portfolio would look like and what are the countermeasures you need to think of. And of course, the risking options. So there are basic strategies to get back to a regular risk parameters and to fall back within boundaries. So this is the starting point, analyzing risk and the metrics of the portfolio. Then we move on, and I'll leave Tommaso to illustrate this onto portfolio positioning. Tommaso.
Now, portfolio positioning is where we take a step forward into really deep diving into how a portfolio is really positioned, not just on past events, but also on simulated future events. Now, this is where it actually becomes a little bit more technical, and I need to slow down a little bit to kind of transfer you some basics knowledge on how we work. So what you see here is a surface. A surface that, we have to describe the axis. Basically, on the frontal axis, we are the market scenario just in front of you. They go from, the most positive, so strong positive scenario. Now, these are market scenarios that are both from the past and simulated. Our AI simulates learning from the past, potential evolution going forward. So from strong scenario, organized from high volatility, this area, middle volatility, and low volatility, clustered that way. So strong positive scenario, lateral scenario, and then negative and strong negative scenario. Each one of them, we just represented, the worst one and the best one, but each one of them, as you can tell, high vol, mid vol, low vol, is divided into, different level of volatility. So on the bottom. Over here, there are days. So how long this scenario lasts. So for example, I'll take this example, positive mid vol. What if it lasts 20 days, 30 days, 40 days, all the way to 120 days? These are, trading days, not so business days, basically. And on the vertical axis, you find the performance over the benchmark. So we're not seeing a performance in terms of total return of the portfolio, but this is the performance of that portfolio that we receive from the client with this, applied to this simulated scenario on a given benchmark, to kind of understand if that scenario happened, how is the portfolio gonna react, in different scenarios. So this is one of our clients' portfolio. Now, as you can tell, it's not that immediate, but I'm just gonna go through again. These are the important stuff that we have to remember. So on the top, on the left-hand side, we find the strong negative scenario, all the way down to the strong positive scenario, both past and simulated. On the vertical axis, again, performance, so overperformance on the benchmark. So the higher the point, so of course, this is a highly performing, this is a portfolio, for example, that performs very well on strong scenarios. You can tell this area is very high, and it performs very, very poorly on strong negative scenario. Okay, and these are the data for how long that scenario is going to last. Now, as you can tell, this surface that it's not moving to give you a better perspective kind of tells the picture quite nicely, because immediately you can understand that this portfolio underperforms badly in strong scenario, particularly in high volatility. So within the strong negative scenarios, both again simulated and from the past, if we have to take careful look that it's a portfolio that tends to perform very, very poorly, particularly in high volatility scenario, whilst it overperforms in positive scenario. Now it's interesting and it's very, it's a detail, but it's very important to know one thing. One might think, okay, this is, some sort of portfolio, but there are some asymmetric aspects of the portfolio that are worth pointing out. For example, here we have a dynamic where, the worst performing portfolio is the high vol. On the contrary, when the scenario is positive, actually the best performing scenario in which this portfolio tends to overperform the benchmark is actually the high volatility. So actually high volatility represent a maximum and a minimum to a certain extent. If it's a high volatility scenario on a strong positive scenario, this portfolio tends to perform quite well. And also if it's just a positive scenario, whilst if it's a high volatility on strong negative scenario, then the portfolio really comes crashing down. So this, it's a hint on where this information lies, which is highly related to correlation and how related to the asset allocation underlying is structured. Now I'm going to make now a comparison to a different type of portfolio, which you can tell it's on the right hand side. It's a different animal, but has the same exact macro allocation. So the two portfolio, the one on the left-hand side is the one that we've seen already. The one on the right-hand side, we haven't seen yet. And the two share the same macro allocation, but the micro allocation, so the allocation within the different bits of the pie, bits of the allocation are different. And as you can tell, these are portfolio which perform completely different. On the left-hand side, once again, we've seen already that it's a portfolio that tends to underperform, while the scenario tends to be strong negative. On the right-hand side, we find a portfolio that, on the contrary, is quite robust if the scenario is strong negative, as it is if the scenario is strong positive. But it's a portfolio that tends to be not so performing when there is a low vol environment, low vol scenario. And as you can tell from the highlighted bits, it doesn't matter whether the market is in a negative, strong negative, negative, lateral, or positive phase. The low volatility, you can see this valley almost. This shows this deep portfolio, because of how it's made, because of how it's structured, tends to be performing different. Now, we know that different market requires different portfolios, so it's key, and it's even more relevant now. So the question goes back to, where do you see, and also with us, the next scenario evolving in the future? Because, for example, the portfolio on the left-hand side might be a very good portfolio if we're looking forward to a very bull market. We can clearly see that in a bull market, the portfolio on the left-hand side tends to really win against the one on the right-hand side. But on the contrary, the portfolio on the right-hand side is a portfolio which is quite suited for high volatility scenario. Doesn't matter whether the market is lateral, negative, strong negative, are we headed against a double dip of the market, or strongly positive. These are portfolio that, for construction, it tends to be very robust when the volatility goes high. So this, this kind of shows you the difference level and the in-depth level that we are able to achieve using our technology. Now, to give you a better idea on how our engine actually works, this is kind of visually graphic appealing. The reality is that it's very down to the nitty-gritty of computing.
It's much uglier than reality.
It's much uglier than reality, on the contrary, but this is not what you get. You get the final result. But this kind of shows you the document that our model produces. And as you can tell, we're able to fully customize all the different elements if we need to kind of address different parts of the portfolio. This is just an example, but in the end, this is the true surface that our model spits out. Those that we've seen before are true likewise, but more graphically nicer to be seen. This is the final output of the model. Now, this is the second step. So we started by, and we always say, to analyze a portfolio, you need steps. First one is understanding where we stand, which is analytics, past scenario analysis, and kind of be strong on where we start from. Then we dive deep into simulated scenario and past scenario. As time passes by, what do we expect from this portfolio? To see if this scenario might happen, what are the different risks that the portfolio is exposed to. Finally, we add a little bit of our twist, which means using our proprietary model to kind of give the last bit of the puzzle, I would say, which is the portfolio adjustment that we suggested. So basically, going back from the experience, we start by an input, which is the portfolio, the current portfolio of the client that we receive. Okay, then we get the constraint of the portfolio, because it's important to see, in order to make adjustments and suggestions that are relevant within the environment, and then the scenario view of the client. So what he expects that it's going to happen. Then we run our model. As we said, two steps. One is fairly analytical. The second one is where it gets in depth. And then finally, based on the outcome of the portfolio compared to our proprietary model, okay, that projects a probabilistic evolution of the scenarios, then we address potential improvement to address efficiencies. Now, we all know that, in a large portfolio, even not so large, a couple of bips in performance might yield a huge amount of, performance in terms of revenues for the company in the future. So often it's key to kind of address those little opportunities and risks that are, lies in a portfolio construction, to kind of truly address them in order to make the portfolio as efficient as possible and therefore as performing as possible.
If I may add, Tommaso, on this, one of the constraints, if you could go back just a second to the previous slide, you mentioned the small differences that in the portfolio that can make a huge difference in performance and in revenues for the company. I would add that among the constraints we take into consideration is the transaction cost of the client. So for example, if we are aware you cannot like take your portfolio and change it for another one, then we want to suggest that. We would suggest the best you can do given the limited amount of turnover you can allow for. So that's a part of the job as well.
Actually, to be more precise, even more precise, Federico raised a really good point. When you have strong constraint, that's when a system like this comes even more in handy, because it can really highlight you cannot move everything, so you can really understand the cost benefit of every single transaction to say, okay, this is really worth it, this is not really worth it, let's leave it like so. So I guess that this is where it gets even more appreciated, I believe. I would leave then Axel to kind of recap everything, to kind of give the client perspective and of what he gets, because we've been, we did, touch briefly, but on a fairly technical thing. And then, Q&A section is now open. You can pose question using the Q&A button on top, and we're happy to answer all of the technical questions as well. Thanks.
Thanks, Tommaso. Maybe before I summarize that, I think the other thing too is worthwhile pointing out. If you look at these surfaces, so if you maybe go back 2 slides, these surfaces, and then the one we suggest is actually a result of running the model across hundreds of different data points and categories. So then as a result, we have what the adjustment is going to be. So it's not like a very easy thing. You put in 5 numbers and you get something out. It's like hundreds and thousands of data points that are used. So the model can learn from that and kind of amplify certain impacts. And so I think that's the interesting point about the AI in this. It's not just quant, it really is the amplification it does through that engine. And if you talk about a client experience, so this is kind of the additional benefit for a client, that in terms of this diagnostic, you have a portfolio where there are certain guidelines within the portfolio works, but to make sure it is actually well suited for scenarios that might come up, that might have a huge impact, as we have seen in the last couple of weeks. And this is where AI can be very, very effective. And so with providing an input in form of a portfolio, including the guidelines, some of the constraints, some of the risk parameters that are important for us to test that and run an analysis out of it. And then as a result, having a better understanding of the risk scenario, understanding how a performance would have worked in certain crises, which is an interesting insight, but then also getting a suggestion how the efficiency of the portfolio can be improved with, trying to minimize the trading costs coming with it, is very critical. And it's very objective. It's AI, so there's no emotion involved in that. And in a scenario that we have just experienced very painfully over the last few weeks, I think that's very critical. And it also helps, and I think this kind of shows that a bit, that within AI, there's no such thing as a model portfolio, since AI is able, without the models we have developed, to build every portfolio bespoke from the bottom, make sure it's 100% fit to the constraints and guidelines. Whereas with the model portfolio, you have to tweak the portfolio to make it fit within the guidelines. And so this is coming through in that analysis here as well, that the portfolio at the end that we can suggest through that would be something that fits within 100% of these guidelines. And so I think with this, I want to leave that. I want to make sure we have enough time for questions. If anybody has more questions, please feel free to get in touch with us. We're happy to go more into detail about this, but I'm also sure you're curious about some of the things we have said. So please let us know your questions. We're happy to answer them.
Fantastic, thank you, Axel. I'll move on to the questions in just a second. Just let me show you what you're getting in terms of service. So we discussed what's in it, but how does it happen? Basically, 4 steps. The first one is the one where we interact with you. So we get from you your portfolio, your constraints, and your market view. So that means I have this portfolio under certain constraints and I want it to behave in a certain way because I expect this to happen, or because I don't know what's going to happen and I want to hedge among the possibilities that are out there. So that's the first part. The other parts of the job is what we described. So risk analytics, dynamic positioning of the portfolio, and portfolio adjustment starting from the portfolio you share with us. What you're getting is a report taking into account all of this. So all the data we've seen, plus the identified suggestions and adjustments to move the portfolio in the desired direction. Of course, we would be meeting, hopefully in person, if not during these weeks, these difficult weeks via video call, and discuss what we found out and discuss the results. So that's how it would work. I'll encourage you to write even more questions. There are already a few, and I'll start asking Tommaso and Axel to give us a feedback on those. So there are a couple of questions which I put together from Marco and from Giovan Battista, talking about the AI. Where is the AI part? How does it look like? How is it involved in the process? This is for Tommaso, I guess.
Yeah, so it is involved in different phases. Of course, in the first one, the analytics, it's just an analytics, standard analytics. There is a little bit of, our experience with the alternatives in being quite robust in addressing the past scenario analysis. So even in a portfolio which is made of fund, the decomposition of those funds into elements that we can go back and test in 2008 is something that, there is a little bit of our machine learning capabilities there. But where it's really at our core and our strength, it's within the projection scenarios, and then the suggested adjustment. So in the projection scenario, it's for 2 reasons. One reason is that we could say it's an evolution of a Monte Carlo simulation, if you will. So rather than just randomly, Monte Carlo simulation is quite a clever methodology indeed. Don't wanna say the opposite. But the problem with Monte Carlo simulation is that it's really heavily dependent on how you actually input the data. So what we actually developed is a system able to do kind of like a Monte Carlo simulation, but whilst being at the same time way less parameter dependent. So it's really less important how you put the parameter in the first place, and then the machine that does the rest. Then at the same time, it's a concept that the second reason, always in the same paragraph, I would say, is what Axel suggested. We don't just run that analysis that we've shown. We actually run the same analysis on every parameter and factor as well. So we're not just interested into understanding how the parameter within the scenario might gonna look like, but on other parameters as well. I'm reading an email message that I get from the team, which is related to a question that Ronald posed, which is, can you take into account ESG exposure and constraint? That's another surface right away. So effectively, that's a job that a human could do. The difference is that rather than having a human, we have at the same time hundreds of surface and thousands of surface with all the different parameter configuration to really understand how robust the model is. And this is just on the bit of scenario and projection scenario analysis. Then lastly is the adjustment. Now the adjustment, lies within our proprietary models, which we use for our advisory service. That's when a client actually gives us a mandate to be an advisor to a portfolio. In that case, we use I would say, the model on a separate level. So we run our model, and then we interact to see how the suggestion that come out from our model actually interacts with the portfolio that that we are given by the client. And then, you know, our team basically makes runs the machine to make sure that, you know, that process runs smoothly, and basically we can actually get, you know, the positive input of our forecast that we have on our advisory portfolio, and we can transfer a little bit of that to the, you know, existing client portfolio in order to meet the requirement.
Fantastic, thank you, Tommaso. Super quick, I'll give this to Axel as to clarify the different services and the different stuff that we do as a company, because there's a question: how often do you rebalance? So it's not the case in this type of service. Axel, if you want to recap all of that.
Sure. So the sanity check is basically what we do as a we would usually do like 3 times once per month. So it's like almost like not a one-time thing, a 3-time thing where we would offer that, and we can do that across as many portfolios as possible. So although we use our AI models to that, the client for this service does not get actual access to the model. Asset allocation is something that would be done, we run on a monthly basis. It's breaking down a client, or it uses clients' guidelines, so clients can give us ideas about regional restrictions, sector restrictions, etc. We would use our models to come up with an asset allocation based on these guidelines, and that's usually going down just to the sector and regional level, and the clients would use that as input, it's almost like research across various portfolios they run themselves. And so the last one, it's pretty much like running a portfolio. So it's very bespoke, depending again on the restrictions the client has. We would run that portfolio, we would basically do everything besides the execution. So the client would get updates, usually also on a monthly basis, although the portfolio is of course monitored on an ongoing basis to make sure there are no breaches of guidelines, but on a monthly basis, clients would get a revised allocation, and the client would then do the execution. But the advisory bit is like running a portfolio, managing a portfolio. So I hope that clarifies the 3 different things we do.
Thank you, Axel. Yes, on to the next question. This one again for Tommaso. There's a question about performance in the last quarter compared to the benchmark. How do we answer that, given Axel's answer before?
So within I will just go back to that portfolio sanity check, which is what we presented, is something that, you know, we do I would say one-off or more time in as time goes by, but it's a study on one particular portfolio and how to position. Performance of our model refers to our advisory service. Now, it depends from client to clients, because each client has a different investment universe. But in general, I would, you know, sum it up like so. In the equity space, I think that's where we yield the most. Our equity model, on average, you know, have achieved an overperformance of roughly 8 points against the benchmark. So we're quite happy about that compared to the, you know, within, you know, these complicated phases. Whereas our multi-asset portfolio which is, you know, tends to be closer to the benchmark for construction, yielded a performance over the benchmark, which is in the space of 3 to 4% over the benchmark. So probably addressing another question, which is, has your model been able to see coronavirus coming? The answer is no. And the reason is because there was no information out there to kind of tell what was going on, and if everybody was able to, and anybody was able to see that coming, most of the time is luck, rather than you know, really understanding the market and seeing an opportunity.
Sorry.
Yeah. So just to conclude, and then I'll leave you, Axel. Basically, the reaction that our model had in general was it was quite well diversified, both the equity and and the multi-asset ahead of the crisis. At the beginning of the crisis, the model just did a short, a small de-risk, and kind of waited a little bit because it saw the risk to noise ratio, the signal to noise ratio having the noise kind of spike, and so it didn't quite move. And then it de-risked it a little bit more and positioned the portfolio for a potential rebound, which happened. And so this is why we were able to do what we did.
I think that's I think was a very good question, a very helpful answer as well. Since it's important to understand what AI cannot do. I mean, this is again what we try to make sure that there's a good understanding of everybody who uses what AI is able to do. It's not the crystal ball, and it's not something that predicts the future to 100%. But as you hear from the numbers that Tommaso just explained, it does help you to react very quickly and see scenarios through that learning algorithm that actually can help to de-risk a portfolio and position it in a more balanced way. And I think that's the critical thing to have that development. But it's also clear, it would not have told us to go into cash at the beginning of February.
I'll get back to, thank you, Axel. Get back to Tommaso with another question, which is from John. And basically it's about the second of the three steps we've seen. So the surfaces showing the behavior of the portfolio compared to the benchmark. How, can you please go back to that? Basically, it needs clarification.
So, okay, so going back to the reaction of the algorithm within the crisis, is this?
No. The question is more about the surface you've shown, where the portfolio is shown the over or under performance compared to the benchmark. So what that surface shows, and what does it tell in terms of portfolio analytics? So if you could expand and go back to that and basically recap a little bit.
Absolutely. So I guess it would make sense to kind of go back, let me close this. Go back to, in the first place, what a simulated scenario looks like. So once again, and this is, going back also to a question that I think Marco posed just a while ago on how we run this simulated scenario. But basically, everything starts by putting the portfolio in a position where we're able to simulate scenarios that are actually relevant and actually meaningful in terms of potential evolution of a portfolio. The goal is not to just go back and cut and paste it. We did this earlier. This is, when we see this is, clearly just going back and taking that same exact scenario and projecting, which is to a certain extent interesting, but there's a lot of, we all know that the market is ever changing. So we need to come up with systems that are able to reliably represent a possible future evolution of the market. Now, Monte Carlo simulation does represent a viable option, but as I said before, it tends to be quite heavily parameter dependent, whereas our system basically learns from the past and understand, I don't want to get too technical, but basically understand from the past how market might behave in the future, I would say that. And then we apply the model to that scenario to see how he would be performed. Now, this is on the performance. Then there is the parameter robustness. And it's something that we don't see here in this surface, but at the same time, while we do this, our model checks for different exposure on other risks that are not shown in this slide. Our performance is not barely, mainly driven on scenarios, but it's also driven on exposure. How is this portfolio exposed against momentum, size, value, the known factor? And to kind of understand if that, if those surface also tells us a different picture. And this is something that you don't see here, but you see, and you don't even see here, but this is within the parameter that we analyze in order to come up with the suggestion that, we need to give you.
Fantastic. One more question. which is again on the other part of the services we have. So the allocation model we discussed, and how does it take into account market liquidity? How does it do? Basically, I'll take this question and leave to Tommaso to add some more details. So the market liquidity is not a direct input of the model, as we only use structured data, and in terms of, so we use returns, their distribution, and the covariance and variance that they generate. So basically, how we hedge against spikes and difficulties in liquidity is by taking returns into context. What I mean by this is, in the last few weeks, we've seen that rebalancing, doing a trade, entering corporate bonds or exiting corporate bonds one day or the following one, was riskier than staying put, basically. And that was shown by means of other parameters, rather than liquidity itself, but by volatility, by the volatility of those asset classes compared to the others. So I'd say this is part of the answer. Tommaso, if you want to add something.
Yeah, if I can add to that is, often when we, and this is, where artificial intelligence, happens to give an advantage, is that, often we want to give data or an input to the machine or to an algorithm in general in order for it to make a decision. And there's a very human factor into putting that that data in. So if you want to develop, I would say, I'll make an example on ourselves, mistakes that we made in the past. So at the beginning, going back years ago, we wanted to, make a system able to make a better forecasting on volatility for option pricing. Okay, a completely different model. And this is, one of those ideas that actually didn't make it through through the clients, but actually died before in our lab. Anyway, we wanted to, have this model. It was clearly able to learn some pattern of volatility and understand the possible future evolution. But we were trying to give the data to the machine by giving different type of volatility. It was always the same volatility. It was always the same returns, but we were giving, we were giving GARCH 6 months, 8 months, 12 months. The reality is that we realized that the model was not really successful because the machine could tell that it was always the same data, because it could get the volatility from the distribution of returns. So for us as human, having the volatility on 3 months, 6 months, I don't know, moving average, those are things that for us as human, they make sense. We can understand. For a machine, we can tell that by the distribution of returns. So some things might be inferred by the machine, so there's no need to put that into to force that data in the first place. And that's the case for liquidity, for example. Liquidity is a very delicate variable, and when you put it inside, you have the feeling that you're giving a lot of information, and you tend to push the model to recognize that information. I'm not saying that you cannot do that properly, but there's a high risk in that. Whereas that same information might be derived by other element in the equation, and this is what we see. It happens all the time.
Thank you, Tommaso. I'll move on to the last question, I'd say, for Axel, and then we wrap it up. And if you have any other additional questions, and if you want to know more, drop us an email at my email, federico.invernizzi@mdotm.eu, or any other of our email. And the last question for Axel is from Francis, and it's good that it's the last question, so we wrap everything up, which is about the pricing of this service. How does it work?
So we'll just talk about the 3 different services we offer. So the sanity check is basically priced on a per portfolio basis with meaningful discounts given for multiple portfolios. The asset allocation service is an annual fee. It's a fixed annual fee, and the advisory service is on an asset base.
Okay, fantastic. Guys, I think this is it for the time being, and thank you everyone for attending and for having so many questions. We will be happy to answer even more questions. So thank you all. Good afternoon.
Thanks a lot.
Thank you. Good afternoon.
Bye-bye.